Welcome, everyone. Thank you so much for joining us today. Hope everybody's doing well. As many of you know, our goal with these quarterly webinars is to help educate our clients and friends on current events and how they impact our thought process and you personally. Our end goal is for you to feel more confident in the decisions we're making together, and then ultimately to make you a better investor. As a reminder, please put any questions you might have in the Q&A icon at the bottom of your screen on Zoom, and then hopefully we'll be able to get to those at the end of the presentation. Let's go ahead and get started. I'm going to share my screen. We got quite a bit to cover today. All right, so how do we handle increasing uncertainty that I think we're all experiencing today? I quote from a motivational speaker here, fear is often our immediate response to uncertainty, and there's nothing wrong with experiencing fear. The key is to not get stuck in it. So how can you not get stuck in fear and uncertainty? We think a key component is being educated and aware of the risks. Today, we're going to start by talking about the key investment risks that we're seeing out there in the current environment. Then we're going to transition to how investors can protect themselves against some of these risks. Investment managers talk a lot about diversification, but this is an environment where it's really made a difference. We're going to look at how traditional diversification hasn't been cutting it, but where true diversification has made a real impact. Finally, I'm going to turn it over to my partner, Chris Galeski, who's going to focus more on the personal financial planning side of things and talk about how understanding what you can and can't control in a world of uncertainty. All right, so this first quarter performance chart looks a lot different than any we've shown in recent years. Traditional asset classes were all down. And I think that most investors know that this kind of volatility isn't at all unprecedented with stocks. So you can see here that in the black on the bottom, on the far left, we've got US and international stock indices down anywhere from 4.5% to 7.5% for the first 3 months of the year. But for bonds to be down this much in this short period of a time is a really significant move. So you can see here short-term bonds down 2.5%. And then more traditional bonds, typically US Treasuries and corporate bonds that have more intermediate term maturities, were down almost 6% in just 3 months. So basically any mix of traditional stocks and bonds would have been down over 5% in this first quarter. Commodities were obviously the big star of the quarter, and we're going to touch on that in the coming slides. There's a lot of volatility now, and we're monitoring the situation closely. This is obviously a short-term period of time, but so far we've been really pleased with how our portfolios have fared. As most of you know, we are very focused on creating resilient portfolios, and even when the stock market was down over 10% in the middle of the quarter, our portfolios were holding up nicely. Of course, it helps being underweight to stocks and having almost nothing in the way of traditional bonds when these are the returns you're looking at. But also a lot of our private alternatives performed exactly as planned or better. So again, we're going to come back to a lot of this later in the presentation. All right, so I'd like to start with a quick polling question. Chris, if you can put it up, that'd be great. All right, so which of these investment risks are you most concerned with today? So valuations, geopolitical risk, inflation, or all of the above? I'll just take a sec here, let everybody answer. All right, let's go ahead and get the results, please. All right, so interesting mix here. So like all of the above, about 50%, about 20% geopolitical risk, and about 26% inflation. And then valuations get a very, very small percentage. So we're going to hit on all these risks today. So we're going to go through valuations quickly, geopolitical risk, as well as inflation. And so it's going to start out not super cheerful, but then I promise there are some very positive takeaways as well. Valuations were our main focus last webinar, so I'm not going to go into too much detail today. But just sort of to recap, this is a price to sales chart, which is one of our preferred measurement tools for valuations. What you can see here is that by this measurement, broad valuations on large US stocks are still extremely high. The recent drawdown in stocks brought valuations down slightly from their peak, but it really didn't make much of a dent. As a reminder, high valuations on their own aren't enough to cause corrections, but they do make it a lot more challenging if volatility picks up. So here's a reminder on why we should care about valuations. History tells us that current valuations tie in directly with future returns. This is a chart we've looked at in the past, and it compares historical stock market valuations to their returns over the following 10-year periods. So you have the horizontal axis along the bottom measuring valuations. The more expensive a market is, the farther to the right. The vertical axis is the subsequent 10-year returns after those valuation measurements. So the connection between these two data points from this chart is really clear. The more expensive the market valuation, the lower the return that investors can expect over the following 10 years. Today's expensive valuation is showing that investors can expect returns to be barely positive for the next 10 years. While this chart makes it clear the connection between valuations and future expected returns, it does not give any indication of timing. So what's the impetus for valuations to come back in line with historical averages? Maybe an external geopolitical shock. Unfortunately, we're all very aware of the awful humanitarian crisis in Ukraine. We're going to focus today more on the potential impacts of this geopolitical event on the world's financial systems. In some respects, the direct role of Russia and Ukraine in the global economy is small. Together, they account for only about 2% of global GDP and a similar proportion of total global trade. But they're extremely important when it comes to the supply of certain commodities. This chart looks at the percentage of commodities that Russia and Ukraine contribute to the global supply. Neon, you can see here in the yellow, is a lesser known gas, but Ukraine and Russia together represent about 70% of the world's supply. This gas is involved in semiconductor chip production. In the base metals, you've got these two countries providing over 40% of the world's palladium, also used in semiconductor manufacturing, and also a core part of catalytic converters in cars. So these countries are also significant suppliers of titanium, platinum, and nickel. Switching to food, you've got ammonium nitrate, which is a key ingredient in many fertilizers. Russia and Ukraine produce over 60% of the world's supply. For wheat, you've got about 25–30% of the world's wheat production that's coming from Russia and Ukraine, and they're also big exporters of corn and sunflower oil. Even though wheat isn't the highest percentage on this chart, it's important to focus on because it actually accounts for about 20% of the calories consumed by humans globally. We're going to come back to the fossil fuel section in a minute. Let's zoom in on wheat, though, for a second. This chart looks at how reliant various countries are on Russia and Ukraine combined for their wheat imports. So Russia's in blue and Ukraine's in orange. And what this shows us is there are quite a few countries that get 20% or more of their wheat from Russia and Ukraine. In some of the larger Middle Eastern countries like Turkey, Egypt, and Israel, wheat imports from Russia and Ukraine represent around 50–75% of total wheat imports. A complete cessation of wheat exports from Russia and Ukraine would result in serious shortages in many countries. If there is a ceasefire, hopefully, in Ukraine in the coming days, the problem is that it's still too late for there not to be a major disruption in a number of different Ukrainian crops. You also can't look at any of these crops in a vacuum. Wheat, for example, isn't just wheat. There are tremendous second-order effects to rising wheat prices. Grain is the #1 input cost of feeding cattle, for example. So if grain prices stay up, the cost of beef will go up. Everything is interconnected. Unsurprisingly, the Ukraine crisis has created a spike in food costs around the globe. There could be a pullback if things are resolved in Ukraine, but a lot of these supply problems could take many years to unwind, especially as Russian sanctions aren't likely to abate anytime soon. Tragically, these kinds of price spikes disproportionately affect poorer countries and people, and much of this is setting the stage for major food shortages, famines, additional humanitarian crises. Let's switch tracks a little and look at Russia's supply of fossil fuels now. So in 2020, Russia provided about 11% of global oil supply, behind Saudi Arabia and the US as the two largest producers. Russia's supply of natural gas as a percentage of global supply is a bit higher. It's a little under 20%. Importantly, though, certain countries are in much worse shape as it relates to relying on Russia for their energy. Europe is particularly vulnerable as Russia has provided over 40% of European natural gas and coal imports until recently, and about 25% of Europe's oil imports. This chart shows that some European countries are worse off than others. The bars show the cumulative percentage of gas, oil, and coal that European Union countries import from Russia as a percentage of their own energy needs. The numbers are pretty startling, as a number of these countries get a third or more of their energy from Russia. So everyone's feeling the pressure at the gas pump these days, with gasoline prices up big across the country and much of the rest of the world. So with energy very much the focus, it can be easy to forget how many products actually rely on oil. So here are just a few of the items that use petroleum in their production. Some of them are kind of surprising, some of them not. I think paint, most people probably know it's in there. You've got vitamin capsules, basketballs, ballpoint pens, purses, sweaters, mops, soap. Any skiers out there, it's used in your skis, perfume, golf bags. There might be quite a few people on this call who would be upset if they couldn't get a new golf bag, boats. So it's just another reminder here, though, that everything is interconnected, right? This isn't just affecting one thing. It has a very wide impact. There are a lot of immediate impacts of on the global economy that are going to be felt from the Ukraine crisis, but we would argue that the largest impact is likely to be a further acceleration in deglobalization trends that we've seen in recent years. As a quick background, post-World War II, there was a huge push toward globalization, where economies and businesses around the world came together to create a truly global trade network and financial system. This chart tracks globalization trends as measured by the total global trade imports and exports as a share of the world's economic output. You can see that starting in the 1970s, there was a meaningful shift toward uniting the global economy. Globalization has many wonderful benefits. It's lowered cost of goods and services, it's spread technology and innovation around the globe. However, starting around a decade or so ago, this chart shows that the strong positive trend started to reverse itself modestly, and then there's been an even steeper decline in recent years. The recent decline makes sense in the context of Trump-era policies surrounding tariffs with China and other countries. And then the dip in 2020 is pretty intuitive, as COVID caused countries to put their domestic interests first and make sure they had all their necessary supplies, think masks and vaccines, before the rest of the world. In some ways, COVID was a wake-up call for countries as they realized that having certain essential products and services offshore may be more efficient long-term, but that really doesn't help you in times of crisis. In the wake of COVID, even pre-Ukraine crisis, countries started to realize that they had to be more resilient. If we can't make cars without certain very specific parts that are only made in China, for example, we're in trouble. We have to have more potential supply sources, and preferably some of those sources will be domestic for areas that are truly related to national security. Russia attacking Ukraine has now put this deglobalization trend into hyperdrive. It's one thing to run out of toilet paper or even semiconductors, and another thing entirely to run out of food or energy. Further complicating things, the financial sanctions that the United States put on Russia were a major push toward further deglobalization. Our actions put the world on notice that we can shut them off from the global economy and even their own reserve assets if they're bad actors. And look, you might say that non-bad actors really don't have anything to worry about, but it's not really a comforting thing to rely on the opinion or labels from one country to determine if your economy can function. The world was given a wake-up call that if they want to be more resilient, they need to financially diversify away from the United States and the US dollar. This really isn't the end of the world, though. It might sound kind of doom and gloom, but it's really just a shift, and it comes with pros and cons. For national defense purposes, the US also needs to be more self-reliant and less intertwined with the rest of the world. This is just a change in mentality back to the pre-World War II days when each nation stood on its own and was less dependent upon others for its own growth. However, one of the inevitable results of deglobalization will be higher inflation. The focus is going to shift from getting cheap products to being resilient as a nation, and that's going to lead to higher prices across a variety of products and services. Last year, we spent a lot of time in one of our webinars digging into inflation and its risks and potential impacts. The recent inflation numbers have been very high relative to history, especially recent history. Taking a look at this chart from JP Morgan, it ends through February, so it doesn't have the most recent prints, but it shows the monthly inflation numbers for the past year and what the underlying components are that contributed to the numbers. So for February 2022, the inflation number was 7.9%. JP Morgan broke out the different categories that they thought represented more sticky or permanent inflation that was going to last, and those that were potentially more transitory. The sticky component on the bottom half, you can see here, represents still around 4% inflation, so much higher than the 2% total that we've seen in recent years. While some of the categories they're labeling transitory, like energy, vehicles, and food, may ultimately drop lower, the question would still be how far they fall and how long it takes for them to get there. Interest rates have skyrocketed in response to the recent rise in inflation. This chart looks at the changes in certain key interest rates between year-end 2021 and just this last quarter end. You can see that there is a meaningful jump in rates across the board. The last column shows the percentage change to give you a sense of the magnitude. And these are huge percentage increases in just a 3-month time span. The lowest number on the chart at the bottom is the one that the Federal Reserve actually controls, so the Fed funds rate. The Federal Reserve did do one rate hike this quarter, taking short-term rates from 0.25% to 0.5%. There are expectations that the Fed's going to continue hiking interest rates through this year. I think the projections show it getting all the way up to 2.5% or above. The Fed, though, is somewhat backed into a corner, right? They really have no choice but to raise rates in response to this inflationary pressure. Ultimately, though, increased rates could put pressure on the economy and lead to a recession. The mountain of debt that our country's built up, including both government and corporate debt, has only been sustainable because interest rates have been so low for so long. If rates rise in line with expectations or even more, there are going to be repercussions. All right, we just covered these three investment risks: valuations, geopolitics, and inflation. Now let's talk about investment portfolios and how they respond to these risks. We're going to examine specific asset classes and gauge how resilient we think they are in the face of these risks. We're going to use the color green to label an asset class as being highly resilient, meaning its performance should be somewhat insulated from the specific risk under consideration. Yellow we'll use for those asset classes that are more of a mixed bag, where maybe it's less certain if they'll respond positively or negatively in the face of that risk. The asset classes we label red are those that we would not expect to be resilient and are likely to be heavily impacted by these risks. All right, let's start off by taking a look at a traditional 60-40 portfolio. So this is, I would say, probably the most common portfolio used in the industry, where you've got 60% in stocks and 40% in traditional bonds. And usually, sometimes what you get in there is you get a mix, maybe managers mix in some international diversification, maybe different like global bonds, things like that. But fundamentally, you're fairly limited in the kinds of exposures this portfolio has. So how do these traditional asset classes fare when faced with key investment risk we've been discussing today? Starting with stocks, the answer is bad. So basically, when you look at this, we think that stocks they're going to be very sensitive to all of the risks we've been talking about. Valuations, obviously, we've been talking for a while about, they're very high. So valuations don't cause declines, but when valuations are high, it sort of leaves less room for error and potentially increases volatility. Stocks typically do poorly in the face of geopolitical risk or crises. That's where often you get volatility from a historical standpoint. And finally, inflation. If wage costs are going up, for example, there's a lot of price pressure within companies where their margins, their earnings are going to be depressed, and that's going to impact stock prices. Switching to traditional bonds. Again, these same three kind of risks, like evaluating how traditional bonds will do in the face of these. Also, I guess punchline is bad with a little bit of a caveat. So again, valuation-wise, traditional bonds are potentially even worse than stocks, just given how low interest rates are. And there's just really not a lot of room for error, and you're not making much, you're not getting paid very much, and there's a lot of potential downside risk. From an inflation standpoint, a long-term fixed rate bond is one of the worst assets you can own in a period of rising inflation, because basically you're locking yourself into this low rate, and inflation keeps creeping higher and higher. You're almost guaranteed to lose to that inflation. Geopolitical is the one that's a little bit more of a question mark. In the past, we've seen traditional bonds during periods of geopolitical turmoil be more of a safe haven. So you had, countries, individuals, whatever it was, people buying treasury bonds basically as a flight to safety. That really hasn't been the case so far this year. Again, traditional bonds are down, 6% for the first quarter, even more now. And I think that's to a large degree because the inflation risk has really been a bigger impact in this case. It's sort of overridden the potential benefits of this as a safe haven, at least so far. So if these are the only two asset classes you're using to diversify, we would say that traditional diversification is broken. Stocks have been a great investment in recent years, but they're not resilient in the face of these risks. And bond performance during this period speaks for itself. So again, down almost 6% for the quarter year to date. And I think it's down almost 9% through yesterday. So now we're gonna shift a little bit, and we're gonna look at what a truly diversified portfolio looks like and how it would respond to these risks. The starting point for this portfolio is that it has a lot less stock exposure than the traditional 60-40 mix, and nothing in the way of dedicated traditional bond exposure. So let's take a look at some of the alternative asset classes in this portfolio and how resilient they may be in the face of some of these risks. Starting with private lending. So at Morton Wealth, we've been using private lending as a replacement for traditional bonds for well over a decade. We tend to favor loans with shorter terms, higher coupons, and some form of assets protecting the loans as collateral. The give up is often liquidity, as many of these private loans require investors to tolerate some level of illiquidity risk. However, when it comes to the more traditional risks that we're worried about today, this asset class is very resilient. So from a valuation standpoint, we're favoring managers that are lending on assets like real estate or equipment, and they're building in cushions so that there may be only lending, call it 60 to 65% of the value of those assets. We believe that investors are being paid very well for the risk they're taking. And while these assets might not be immune from a truly catastrophic geopolitical risk, they tend to be smaller and more local in nature, so that events like the ones today in Ukraine are less impactful. Finally, starting with higher interest rates and keeping loans shorter term helps these private loans be more resilient in the face of inflation. The target return for many years on these strategies has been in the 7 to 8% range, much higher than interest rates on traditional bonds. If inflation stays high, these lenders can be more nimble with their shorter term loans and look to increase interest rates on future loans. All right, next let's take a look at non-traditional bonds. Non-traditional bonds are typically liquid on a daily basis, but they look beyond exposure to just US Treasuries or high quality corporate bonds. In the low interest rate environment we've been in since 2008 financial crisis, we've favored either shorter duration managers who don't take on much in the way of interest rate risk, or managers with more flexible mandates who can rotate into some of the more niche bond asset classes that we think are attractive. So certain kinds of mortgage-backed securities, for example. Let's take a look at how sensitive non-traditional bonds are to some of the key risks we're facing today. We would give this asset class more of a middle or yellow score across the board. Valuations in this space are fair. We think you're getting paid reasonably for the risk being taken. From a geopolitical perspective, we would expect that these bonds could have some short-term pricing volatility if tensions continue to escalate. However, the fundamentals behind many of the underlying holdings should support investors' principal once some of the volatility settles down. Most importantly, from our perspective, the bulk of these managers keep their interest rate exposure very limited, so they won't be victim to rising interest rates from higher inflation. All right. Thanks, Brad. So look, we wouldn't expect this asset class to be a star like private lending in the face of these investment risks. However, it still has a place in the portfolio given that it's daily liquid. So far this year, we've seen these kinds of holdings down small compared to more traditional bond indices. All right, private real estate equity is an interesting one when it comes to these risks. So with valuations, we would rank real estate equity yellow in the middle, given how expensive a lot of real estate has become in recent years. There are still pockets of opportunity and attractive values to be found, but as an asset class, it's definitely not cheap, and it could see hits to valuations if rates rise more persistently. Geopolitical risk is also something of an unknown. While real estate is often very local in terms of its performance, a more sustained geopolitical conflict could certainly cool off the real estate market as investors, let's say they hold on to property or hold off on projects until some of the uncertainty settles. A lot of the uncertainty in real estate too today is related to the supply of building materials that have been just skyrocketing in cost, along with other commodities of late. For inflation, however, we feel that the right kind of real estate will ultimately be a resilient place to be. From a long-term perspective, real assets like real estate tend to be attractive hedges against inflation, as property owners are typically able to raise rents as inflation rises. Overall, real estate equity has been a strong performer for a long time, and we feel that given its characteristics, it still has the potential to be resilient and add value going forward. All right, we've held gold in the portfolio as a hedge for a number of years now. It was great in 2020, not as exciting in 2021, and then so far in 2022, it's been a solid performer for us. When it comes to valuations, it's really tough to make an assessment of how cheap or expensive gold is. So unlike real estate, and this is one of the criticisms of gold, there's no cash flow that you can use to model its value from a long-term standpoint. Since we hold gold as a hedge against currency debasement or governments running wild printing money, we think that relative to the amount of money out there, gold looks inexpensive on a long-term basis. But given that there isn't something solid to anchor to from a valuation standpoint, it's possible we could see some short-term volatility in valuations from here. On the other hand, gold tends to really shine in the face of both geopolitical and inflation risks. It has historically acted as a safe haven where investors flock during times of crisis, or when they need to get their money out of paper currencies and into an asset that has historically held its value. We're looking at a very short time frame here, but so far year to date, gold has been up nicely in the face of these risks. All right, finally, let's take a quick look at SPACs SPACs, as a reminder, stand for special purpose acquisition companies. A sponsor raises money in a SPAC, and then they try to go out and find a company to merge with using that money. We only invest in SPACs when they are pre-merger, meaning that on the downside, we're essentially buying short-term treasury bonds, often at a discount. And on the upside, there's some potential for outsized returns. Even though SPACs can have a little short-term volatility when markets are in turmoil, they often don't trade down for very long, given that SPACs we invest in are, again, really just pools of short-term treasuries. Therefore, we see them as being a resilient asset class in the face of valuation and geopolitical risks. From an inflation standpoint, the underlying treasuries in the SPACs holding are short-term, so their yield adjusts upward as interest rates rise. They're also quite liquid, so investors can redeploy funds elsewhere if inflation remains sticky and interest rates don't rise sufficiently to keep up. Most of our SPAC accounts were flat to down small for the first quarter, but given that this investment is structured to ultimately not have any downside exposure, if SPACs are held for, call it 18 to 24 months for their maturities, we feel this asset class adds strong resiliency to a portfolio. So I know we covered a lot of detail, but hopefully this exercise really hammered home how true diversification can create a more resilient portfolio. When comparing our diversified portfolio to a traditional portfolio, I think it's really dramatic how different the exposures are from a risk standpoint. Again, we're only a few months into 2022, but so far we've really seen diversification benefit investors and make them resilient to some pretty challenging risks that we all face. All right, so far we've been focused on risks to investment portfolios, but now we're going to switch gears a little bit and focus more on how individuals can deal with uncertainty in their personal financial situations. I'm going to hand it over to my partner, Chris Galeski, and he can take it from here.
Thanks, Megan. I appreciate it. You know, that last slide on true diversification, it makes me really proud of our team and the things we've been able to put in place to help protect clients. But you know, it's funny to look back and realize how much you become your parents and our grandparents over time. You know, hearing things like, back when I was a kid, that only cost a nickel. If I started complaining about the cost of golf balls, I'm pretty sure my wife is just going to tell me to play better. But all kidding aside, inflation is real and it affects us all very, very differently. If your home is paid off or you have a fixed rate mortgage, inflation is affecting you differently than a lot of other people. You know, in fact, you probably even saw the value of your home increase by more than 50% over the last 7 years. So if housing makes up around, call it 30% of the consumer price index, which is a measure for inflation, and your home is paid off or your housing costs have stayed flat or even potentially gone down in the past, call it 5 to 10 years, your personal inflation rate is potentially 30% less than what's being reported in the news. And look, high valuations, inflation, deglobalization, these are all things that make us feel less confident in our future. So revisiting your financial plan or even creating a financial plan should be the answer. Like Megan, you said to me last week, hope is not a strategy. And that reminded me of one of my favorite quotes. You know, a goal without a plan is just a wish. So if you don't mind, I'm going to walk you through our financial planning process, quantify how these variables outside of our control impact our financial future, and then finish up with a few tips on things that we can control to help improve our financial life. So let's get into our process. So first and foremost, our process, we like to start with the client to truly understand and identify what is important to them. Once we understand and identify what's important to the client and what they're trying to accomplish, we can then look at all of the things that are inside of their control and outside of their control to help design solutions that help manage and mitigate those risks, which is the third part. A lot of other financial planning companies, they might start with solution number 3, saying, hey, here's my shiny little toy, come invest with us, we can solve all your problems. We believe that the process should be flipped on its head, and we should start with number 1, identifying what's important to clients. And then number 2, understanding what we can and cannot control. So let's talk about that here for a second. When we think about the things that we can control versus the things that we cannot, so we can control the relationships that we have or choose to have, not relationships themselves. But we can also control how we react or respond or save or spend. The things that we cannot control is, you know, pandemics, the financial markets, inflation, interest rates. But if we create a financial plan that truly identifies the key risks that clients take on when it comes to high valuations, inflation, potentially even a recession, we can design strategies or solutions to help clients better achieve their goals by making a different decision. So I'm going to walk you through a case study about John and Carol and how we've helped them sort of manage some of these key risks as well. So John and Carol, they're in their late 50s. They have a net worth of about $4 million, including real estate. They have expenses around $200,000 a year, and they want to retire in the next 5 to 7 years. What's important to them is traveling and having experience with their kids and grandkids. Success to them is making sure that they have enough money to last in retirement. Both of them have parents that lived well into their 90s. They also don't want to be a burden on their kids and potentially leave some assets behind, including maybe their home. So the headlines lately have caused them to be a little bit nervous with safe money, traditional bonds not being so safe. Inflation, wars, the potential for lower growth, or even a recession as they near retirement as all factors that they cannot control. It was important for John and Carol to come to us and have a plan that they could continue to monitor to make sure that they are on track and making the right emotional and strategic financial decisions. So we're going to switch over and I'm going to show you our financial planning software. And what you're going to see is you're going to see a chart with a lot of blue lines and a few buttons that I can push and simulate different situations. And let me try to pull it up here. And this is a digital picture of John and Carol's financial life. So these blue bars just represent their liquid investable assets, not including their real estate. And so you see those bars continue to go up in the first, call it 7 to 10 years, because John and Carol are continuing to work and save in their portfolio as they near retirement. They're not currently living off of their assets. So we're taking into consideration what they have, what they're saving, what they're spending, and then assigning a growth rate associated to it to get an idea of how long their financial assets last. And in this current situation, their assets last well until age 100. But again, going back to it, John and Carol were very nervous about inflation. How does it affect them, and will it potentially prevent them from meeting their long-term goals? So as I click this button, it's going to simulate higher inflation for the next 5 years. So their non-fixed expenses. So a fixed expense would be something like a mortgage or a car payment, something that stays stagnant over the course of its life. And so what we are doing by simulating this is their non-fixed expenses are increasing every single year for the next 5 years at 7.5%. And then inflation drops down to more historical averages. And as you can see from this picture, inflation is an issue, but it's not preventing them from having enough gas in the tank to enjoy their retirement or prevent them from retiring on time. So let's go back to high valuations and potential lower growth. How does that impact their ability to save and be on track for retirement? So instead of using a modest figure like 5%, we reduce their growth rates down to about 4.5%. We use a modest number because we don't want this to be the sole reason why John and Carol are successful. We truly believe that we're going to be able to beat this number, but if we are conservative in our assumptions, especially when we're planning for the next 40 years, it makes less of an impact over the long run. So in John and Carol's case, lower growth rates still allow them to retire, in the next 5 to 7 years and create enough liquid assets for them to last out until age 98. So let's say John and Carol came to Megan and I and said, okay, if we're going to have lower growth rates or potentially inflation, should we rebalance our portfolio and take on more risk in order to counteract those risks? It stopped. One sec. Let me try logging back in. Always fun with usernames and passwords.
I'm not the one who broke the technology today. I just want that noted for the record.
We were doing so well. All right. So let's say John and Carol decided that they wanted to take on more risk, or they were worried about the impact of a potential recession. as I click this toggle, we are going to simulate a potential recession for John and Carol. And what this is it's their liquid portfolio losing 10% of its value 2 years in a row. So for the next 2 years, right away. And while this chart seems dire because you're seeing the blue bars, simply wipe away, I assure you it's not, because this chart is not including their physical real estate. Plus, it gives us about 35 plus years of different decisions, or whether it's spending or investment decisions that could help improve their situation. So what they quickly realized is that preservation of capital in their particular situation was extremely important versus trying to make different decisions to impact growth. So now that we've had a chance to kind of look through how a recession or inflation or rising interest rates or even lower growth going forward due to valuations affect John and Carol, we'll switch back into some of the things that we cannot control. So again, we cannot control inflation, interest rates, or recessions, but we can control other decisions. So Meghan will pull up the screen and we'll talk about some things that they can control to make a better impact on their lives. So John and Carol, they could obviously do the not so fun things. They could work longer or spend less or save more. They could, if they haven't retired yet, potentially delay Social Security. And by doing that, their Social Security grows by about 8% per year, but every year they delay. If they're charitably inclined, there's a couple of decisions that they can make. They can leverage something like a donor advised fund and donate stock, not cash. If they're over 72 and subject to required minimum distributions, they could leverage something called a qualified charitable distribution. By donating your required minimum distribution directly to charity instead of receiving it yourself, you can avoid the income taxes on that. They could also potentially do Roth IRA conversions during down markets. Regardless of a number of these decisions, I think that the things that are outside of our control affect how we respond or react. So it's important to make sure that we have access to an appropriate emergency fund or dollars to help navigate turbulent times. So many of us have seen our homes go up in value. Having access to a home equity line of credit, if we don't have enough of an emergency fund, can be a great source to access some dollars in case of emergency. And then, that last part is making sure that we have an appropriate emergency fund. Those aren't all the decisions that they can make. As Meghan mentioned earlier, clients could also build a resilient portfolio. And for many of you, being clients here at Morton Wealth, you've already done that. And so you should give yourself some credit that you are doing a lot of great things during this environment to help protect and grow your assets. The future for investing, that goes back to that saying, what got you here won't get you there. The future for investing looks very, very different. Over the last 40 years, we've seen interest rates go from mid-teens down to zero. The next 10, 20, 30 years are unknown. But if interest rates continue to rise and traditional stocks and bonds don't provide the diversification that they used to, being able to invest and manage and take advantage of additional investments to protect you are extremely important. So again, thank you for your time today. I hope that you found some of this information helpful. Please leverage your financial advisory team for any questions on how some of the things that you can control impact you and whether or not you should leverage them. From there, Meghan, I think we'll take some questions.
Thank you, Chris. So as a reminder, the Q&A icon at the bottom of the screen, you can go ahead and click in there and put your question. We had a few come through already. So the first one I'm going to answer is, so again, I know, sorry if the beginning wasn't as cheerful, but one of the questions was, well, why have any money in stocks and bonds, right? It's exposed to all these risks, so why bother? And I think, look, the answer is we can look at this information and we can say, this is what we think is likely, these are the risks, but the reality is that no one knows, right? So when people or managers come out and say, this is what's going to happen, this is the number of rate hikes, this is what is happening with interest rates, it's a little disingenuous. Like, there's consensus, obviously, but things could reverse course, right? Things could get settled again, hopefully, in Ukraine, and there's peace and we go back on track, stocks take off, bond yields come back down. It's possible you diversify because you don't know, right? Because we're not smarter than markets and can't time and pick like exactly what to do. That's why you diversify. But look, because these risks are so high, that's why they're so low. Like traditional bonds in our assessment don't have a permanent place in the portfolio. We have managers who, again, can make that call if they want to, because they have flexible mandates, so they can be tactical. But fundamentally, if the risk reward isn't there, we're not forcing ourselves to own traditional bonds because we just think we have better substitutes. On the stock side, though, like stocks have been a great performer for a long time. Like there have been risks. These risks aren't brand new, right? So they've been around for stocks for a while, and stocks have done great. So if you'd sold out of stocks years ago, you would have really missed out on an important growth piece of the portfolio. So again, we diversify because we don't know. Chris, there was one question that came through for you related to how much is the right amount in an emergency fund?
I think normally that advice is obviously dependent on each person, but most advisors are going to say somewhere between 6 and 12 months of your living expenses. So if your lifestyle costs, I don't know, call it $10,000 a month, that's $120,000 a year. Having around $120,000 set aside should be more than enough. If you're feeling nervous, don't be afraid to have more, or leverage something like a home equity line of credit for access. You don't need to use it, but at least having access to get you through turbulent times.
One question here about in our traditional stock portfolio, how do we invest in stocks? So active managers, passive, and the structure. So the answer is we actually, many years ago, we used pretty much all active managers who were sort of trying to pick and choose the stocks that would outperform, underperform. And for that service, you typically pay higher fees, for that active management. And so a number of years ago, I think it was back in 2015, excuse me, we made the shift. We switched to more of a passive strategy, but with a tilt toward things that we think are a little smarter. So I wasn't capable of going out and buying just the S&P there are a lot of structural reasons why that's challenging. But if you basically say we're going to start with sort of a more broad index, and then we're going to tilt toward the things that make sense. We're going to tilt a little more toward value, a little more toward profitable companies or smaller companies where historically they've outperformed. That structure made a lot of sense to us. So I would call it a little more like smart passive. And the thing that's nice about that is you're able to control a lot more, right? In a world where we can't control a lot about stocks, we're able to keep expenses lower. We're able to sort of manage tax efficiency. So it's kind of, again, control, back to Chris's point, control what you can control, even on the stock side, in a world where there's a lot that's sort of outside of what we can control. We typically use mutual funds or ETFs for that. It depends on the structure. And then paired with that, we do have a couple of managers that are active where we have kind of strong conviction in a specific strategy that really deviates from the norm or from the index. We'll kind of have more of a satellite approach as well in the stock space if we think that makes a lot of sense. All right. Looking here.
There was one that has to do with how do you deal with alternative assets that are not liquid if you need access to those assets. And I think that's a great question on both sides, understanding the amount of illiquidity that a client can take on, but also the importance of doing the financial planning upfront and being open and honest with your advisory team about the things that you would like your money to do for you, so that way we can structure the right investment portfolio and not have too much of it illiquid.
I think a lot of people have a misconception that they have to have access to 100% of their money sort of immediately. And look, if that's the case, if you actually might need to access 100% of your money immediately, you probably shouldn't be invested in anything. So people think of stocks, for example, as being liquid because I can go click a button and I can sell, Apple stock, that day. That doesn't mean you should sell it on any given day, right? Like if something happens in your life and it happens to coincide with Apple being down big, that's sort of how you guarantee your lock-in losses when you sell at the wrong time. So to Chris's point, I think financial planning is really important to know how much of your portfolio do you need liquid and accessible for your lifestyle, or even, do you have an emergency fund so you don't have to tap into your portfolio at the wrong time? And then with the rest of it, if you can get comfortable with some illiquidity, we think there's a real premium that investors can get paid, for tapping into that illiquidity. There was a question about managed futures. And I don't know if everyone knows where that it's an alternative strategy that's sort of more of a momentum-based strategy We actually spent a lot of time looking at that back in 2008, because that was sort of the darling of 2008, one of the few things that was actually up. I spent a lot of time, took a look, and we ended up not investing, primarily just because it's something of a black box. We tend to be a little more fundamental investors on alternatives as well as, in stocks and bonds. And it's tough to kind of fully understand with managed futures exactly what you're getting exposure to at any one point in time. And just it ebbs and flows. So there's long periods. So actually since 2008, there's been long periods of underperformance. Then this year, it's been one of the asset classes that has performed well. I think we tend to favor asset classes like, for example, the private lending, where we think they're going to do well sort of regardless. So I'm not necessarily trying to call a trend or pick the momentum. I think private lending has risks, but those risks are not tied to, again, kind of the broader macroeconomic risk as much as I think other things are. So I'm looking for consistent returns from that, sort of if stocks are up, if stocks are down, kind of regardless of what's going on. And so that's been more of our strategy, is find things that sort of aren't connected instead of trying to call the trends, if that makes sense. Chris, there's a question on tips as well. Do you have an opinion?
I mean, from my understanding, tips seem to lag actual inflation pretty significantly. And so even in this most recent environment where we've seen the 10-year go from 70 basis points to 2.9%, the last year and a half, tips have even performed poorly. That's my understanding, at least.
Yeah, so tips are it's like treasuries that track inflation or are supposed to have an inflation component that goes with it. And there are some structural problems with them where they tend not to really, to Chris's point, keep up. They're also using kind of CPI numbers that there's some argument about how realistic those are on an inflation basis. But the answer is that I think, because the specific question was whether or not our non-traditional bonds include tips. And the answer is they could. Again, in that space, we're favoring managers who can sort of pick and choose and be more tactical. So if tips presented an attractive valuation, those managers could make that selection. I don't believe that's any kind of a meaningful allocation now, again, because there are some sort of structural things that make them a little bit less attractive in this environment. All right. What are alternatives to gold if you're uncomfortable with the environmental impact? With gold being, I think gold and some of the metals, so silver is another one where it tends to be more of a pure hedge from a long-term standpoint in terms of the currency debasement piece. If it's more just inflation, broader commodities are something that also work from an environmental impact. That might not be the key thing you're looking for, but silver or certain other kinds of base metals actually are really big in some of the alternative energies that are being produced today as well. And certain alternative energy sources, have done well in this environment too. There's been some volatility of late, but as we look at what's going on specifically in Russia and like reliance on Russian energy, I think there's going to be a lot of shifts toward moving away from that, moving away from dependence on Russia. And one of those shifts will probably be a continued move towards certain kinds of alternative energies. It might be more nuclear or other kinds of things that are more efficient or more beneficial for the environment, hopefully, along with being just helpful from an economic resiliency standpoint. All right. I think this question is a 1, but I think, what are your questions on Series I saving bonds with the current inflation environment? We've gotten that question a lot. I think there was a Wall Street Journal article, so.
Yeah, I think there was too, maybe.
You want to take it, Chris?
Yeah, look, I mean, the rate that those I bonds are paying right now, and even projected to go up here in 6 months, is phenomenal. It's just a little bit inefficient to take advantage of for, most high net worth investors, being limited to, call it $10,000 a year and having to set up their own account with Treasury Direct. But look, if you've got some money lying around and it's sitting in your bank account and you want to have another username and password and track it, I think it's a great thing as an alternative to cash, because it is, U.S. Treasuries and it's risk-free rate of return. So it's pretty attractive.
Yeah, it's just does the number move the needle? So 10,000 is the minimum. So I think there was a loophole to that where if you got a refund, potentially part of that could get funneled in, but
up to I think an additional 5,000 of a refund, I believe. Yeah.
Okay. Yeah. So it depends if that's a significant number for someone and they're saving, then that could be an interesting place to keep it. There are also, I believe you have to hold it for a certain period of time to get the interest, or if you give up, there's penalties. So that might be fine. Again, just to some of our clients, if it's that small, is it sort of worth going and setting up the account and having a full, an extra situation that you're dealing with. But in terms of, I mean, they're government backed, right? And to Chris's point, their yields are very attractive right now. So from that standpoint, if we could buy a lot of them, then I think we'd be very interested. But so would everyone else. So
yeah, I think the inefficiency of them, from my understanding, they're primarily were saving additional college savings vehicles for your kids or grandkids. So again, that limit of $10,000 or potentially 15 if you get a refund from the government doesn't move the needle.
One more question here about bonds is that, with interest rate hikes from the Fed coming, should we be, exiting again, like any duration risk, sort of taking away any interest rate exposure? And look, I think that the short answer is that I think a lot of those expected rate hikes are already baked into what we've seen. If you think back to that chart I showed, right, all the rates have moved up big, right? The 10-year Treasury and mortgage rates, everything's jumping. And then the Fed funds was up, a measly 0.25%. So what that tells you is that interest rates have gone up ahead of or an expectation that the Fed's going to be raising rates, or even just because rates need to go up. So at a certain point, people think of the Fed as being in control of rates. The only thing they really control, technically, is the short-term rate, and the market otherwise is the market. And so that's what we're seeing, is that's already sort of moved up and really impacted that. So that doesn't mean that rates couldn't rise further. I would just say, in terms of whenever, again, you think back to what we know, excuse me, we know the answer to this, right? So why don't we react? If something is known, it generally is efficient, it's priced into the market. And then the question is more like, how is that going to deviate in the future? So again, though, we really just don't have a lot in the way of traditional bonds and a lot of traditional interest rate risk. A lot of our bonds, they weren't down anywhere near the 6% for the quarter that the broad bond index was. So I think that's the way we've managed this, is saying we're not going to keep a lot of that exposure on. And, then we can be tactical. Essentially, these managers can switch around if there are interesting opportunities or windows. All right, well, it looks like that is all the questions. So really want to thank everybody for coming today. I hope you enjoyed the discussion. And if you have any follow-up questions, please reach out to your Morton Wealth advisor. And thank you, everyone, and we'll see you soon. Take care.